It is 5:48 on a Wednesday morning in a quiet subdivision just west of Columbus, Ohio, and Donald is sitting at the kitchen counter with the blue-white glow of a laptop washing over his face. The house is still, that particular stillness you only get before anyone else wakes up, and the only sound is the low hum of the refrigerator 2 rooms away. He has a fidelity statement pulled up on the screen, and the number at the top reads $738,400. The combined total of his traditional 401k and a small Roth IRA he opened 6 years ago. His reading glasses are slightly crooked, and his index finger is hovering over the trackpad without clicking, as if the next move might change everything. A second browser tab is open to a Social Security estimator, and the projected monthly benefit at 62 shows $2,317. Donald's jaw is tight, not from pain, but from the kind of tension that comes when you realize the math you assumed was settled might not be settled at all. He scrolls back to the 401k balance, then forward to the Social Security tab, then back again, like a man rereading the same paragraph of a letter he does not want to believe. His wife's retirement is 2 years behind his, and her traditional IRA adds another $214,600 to the picture. The question forming in his chest is one he has never spoken aloud. Whether the money that looks like enough might quietly become less than enough, not because the market drops, but because of something he has not planned for. Donald's situation is not unusual. Millions of Americans in their late 50s are staring at a version of the same screen, holding the same tension in the same early morning silence. The problem has a name, but most people encounter it only after it has already started costing them real money, and that name is retirement tax sequencing. This is the decade where small decisions compound into large consequences. The IRS does not send you a warning when you cross a line that doubles your Medicare premium or triggers taxation on your Social Security. What you are about to see is how those invisible lines work, where they sit, and exactly what you can do about them while there is still time. By the end of this, you will understand why the order in which you pull money from your accounts matters more than the total amount you have saved. You will see the specific income thresholds that trigger higher taxes on your Social Security benefits and inflate your Medicare costs. You will learn how a window of just a few years between your last paycheck and age 73 can save you tens of thousands of dollars. And you will have a clear, step-by-step approach you can put into motion before the end of this calendar year. You do not need a finance degree or a tax background to follow any of this. You just need to stay present and be willing to look at a few numbers that most people would rather avoid. When you are working, your financial life has a certain rhythm. Money comes in on a schedule, taxes are withheld automatically, and the decisions you make about savings are mostly about how much to set aside and where to put it. Retirement changes that rhythm completely because you go from having one primary income stream to choosing between 3, 4, sometimes 5 different sources, each with its own tax treatment and its own set of consequences. Think of it this way. During your working years, the IRS takes its cut before you ever see your paycheck. But in retirement, you are the one deciding how much the IRS gets to take and when. If you are in your late 50s right now, or you have just crossed into your early 60s, this shift is either already happening to you or it is about to. The 3 main account types you need to understand are traditional tax-deferred accounts, Roth accounts, and taxable brokerage accounts, and each one speaks a different language when it comes to taxes. Think of your retirement accounts as ingredients in a recipe. Each ingredient has a different flavor profile and a different reaction to heat, and the order in which you combine them determines whether the final dish is balanced or ruined. Your traditional 401k is the strong base. It carries the most volume, but it needs careful temperature control or it will overpower everything else. A good cook does not dump all the ingredients in at once, and a good retirement withdrawal plan does not pull from all accounts at the same rate. Your traditional IRA or traditional 401k was funded with pre-tax dollars, meaning you got a tax deduction the year you contributed, and the money grew without being taxed along the way. That sounds like a gift, and it was. But the gift comes with a receipt. Every dollar you withdraw from a traditional account is taxed as ordinary income, the same way your salary was taxed when you were working. The IRS treats those withdrawals exactly like a paycheck, which means they land on your tax return and push you up through the federal tax brackets just like earned income would. If you withdraw $80,000 from a traditional IRA in a single year, the IRS sees that as $80,000 of income, period. Your Roth IRA or Roth 401k works in the opposite direction. You funded it with after-tax dollars, which means you already paid income tax on that money the year it went in, and in return, every dollar of growth and every dollar of withdrawal comes out tax-free in retirement. The difference between a traditional withdrawal and a Roth withdrawal is not small. It is the difference between handing a portion of every dollar to the IRS on the way out and keeping the entire amount for yourself. This distinction becomes critical when you start layering in Social Security income, because Roth withdrawals do not count toward the income thresholds that determine how much of your Social Security gets taxed. That single feature makes the Roth account one of the most powerful tools in retirement, and most people in their late 50s have far too little of their savings in one. A taxable brokerage account sits in a third category. You funded it with after-tax money, but unlike a Roth, the growth is not tax-free. When you sell investments in a taxable account, you pay capital gains tax on the profit, and the rate depends on how long you held the investment and what your total income looks like that year. Long-term capital gains rates are generally lower than ordinary income rates, which gives this account a different texture in your withdrawal plan. Understanding how these three account types interact is the foundation of everything that follows. Most people approaching retirement carry a reasonable-sounding assumption. Withdraw from whatever account has the most money in it, or withdraw from the account that feels most accessible, or simply start with Social Security and supplement from savings as needed. That intuition feels right because it is simple, and simplicity feels safe when you are making decisions about money that has to last 30 years. The problem is that this default approach ignores the fact that every withdrawal changes your tax picture, and your tax picture determines how much of your other income you actually get to keep. What feels like a neutral choice is often an expensive one. Here is where the first invisible consequence shows up. If you retire at 58 and start pulling $70,000 a year from your traditional 401k to cover living expenses, you are generating $70,000 of taxable income, even though you are not working. For a married couple filing jointly in 2024, the 12% federal tax bracket covers taxable income up to roughly $94,300. And the moment you cross that line, the next dollar is taxed at 22%. That 10 percentage point jump does not announce itself. There is no letter from the IRS, no alert on your brokerage app, no notification of any kind. If your combined withdrawals and other income push you even $1 over that threshold, you start paying nearly double the rate on the excess, and most people do not realize it happened until they file their return the following April. The second invisible consequence is Medicare IRMAA, and this one catches people completely off guard. IRMA stands for Income-Related Monthly Adjustment Amount, and it is a surcharge the government adds to your Medicare Part B and Part D premiums when your modified adjusted gross income exceeds certain thresholds. For a married couple, if your combined income crosses $206,000, your monthly Medicare premium jumps from the standard $174.70 to over $400 per person per month. That is not a one-time penalty. It recalculates every year based on your income from 2 years prior, which means a single large withdrawal from a traditional IRA in 1 year can inflate your Medicare costs 24 months later. Run the numbers on your own planned withdrawals for this year and ask yourself whether you are about to trip this wire without knowing it. The third invisible consequence involves Social Security taxation, and it connects directly to everything you just heard. If you are married filing jointly and your combined income, which includes half of your Social Security benefit plus all other income, exceeds $44,000, up to 85% of your Social Security becomes taxable as ordinary income. That threshold has not been adjusted for inflation since 1993, which means it catches more retirees every single year. The cascade works like this. You pull from your traditional IRA, that withdrawal counts as income. That income pushes your combined total above $44,000, and suddenly the Social Security check you thought was mostly yours now has a significant tax bite taken out of it. Picture this happening to your own Social Security benefit. If you have been withdrawing from a traditional account without tracking your combined income, this may already be affecting you more than you realize. The result is a tax rate on that marginal dollar that can be far higher than anything you paid while you were working. Now come back to Donald, sitting in that blue light before dawn in Columbus. His 401k balance of $738,400 is almost entirely in a traditional account, which means every dollar he withdraws will be taxed as ordinary income. If he starts pulling $65,000 a year to cover expenses, and his wife claims her Social Security at the same time, their combined income will push them well past the threshold where 85% of both Social Security benefits become taxable, and uncomfortably close to the IRMA cliff. The numbers on his screen are not wrong. The money is there. But the path he is about to take will quietly erode tens of thousands of dollars over the next 2 decades. The dominoes keep falling, and each one lands so softly that you do not hear it until the damage is already done. The cost of pulling from the wrong account in the wrong year is not a one-time event. It is a pattern that repeats every year you are in retirement, and the cumulative damage over 15 to 20 years can be staggering. Consider a married couple paying an extra $8,200 per year in unnecessary taxes because they withdrew too aggressively from a traditional account instead of blending their sources strategically. Over 18 years, that is $147,600 that left their household and went to the IRS, not because they earned too much, but because they pulled from the wrong bucket at the wrong time. The math on this is not complicated, but it is almost never done in advance. There is a window in retirement that financial planners sometimes call the golden window, and it opens the day your last paycheck arrives and closes the year you turn 73, when required minimum distributions begin. During this period, your taxable income drops dramatically because you no longer have a salary. And if you delay Social Security, your only income might be a small pension or some interest and dividends. Most people treat this window as a vacation from taxes. They celebrate the low bracket, spend conservatively, and wait. But that is exactly the wrong instinct, because those low-income years are not a gift to enjoy passively. They are a strategic opportunity that disappears the moment RMDs force large taxable withdrawals back into your life. The counterintuitive move is this. During those low-income years, you deliberately convert money from your traditional IRA into a Roth IRA, paying tax on the converted amount at whatever low bracket you currently occupy. You are volunteering to pay tax now, which sounds wrong until you realize that the tax rate you pay today at 12% is dramatically lower than the rate you will pay later when RMDs, Social Security, and investment income stack on top of each other and push you into the 22% or 24% bracket. The math on a Roth conversion in a low-income year is straightforward. You are buying future tax-free dollars at a steep discount, and every dollar you convert is a dollar that will never generate a required minimum distribution. This is not a loophole or an aggressive strategy. It is simply the arithmetic of paying a smaller percentage now instead of a larger percentage later. When you convert, say, $40,000 from a traditional IRA to a Roth IRA in a year where your other income is only $18,000, you pay federal tax on that $40,000 at the lowest brackets available. The converted money then sits inside the Roth, growing tax-free, and every future withdrawal, principal and growth, comes out with zero federal tax. Over 15 or 20 years of compounding, the tax savings on that growth alone can dwarf the tax you paid on the original conversion. What matters is not just the tax you save today, but the tax you prevent from ever existing in the future. Here is the quiet truth at the center of all of this. The most dangerous tax mistakes do not happen because people earn too much or save too little. They happen because people withdraw without a sequence. And the sequence is what determines whether you keep your money or give it away, one invisible slice at a time. Ask yourself right now which federal tax bracket you are sitting in this year, and whether there is room between your current income and the top of that bracket that you are letting go to waste. Retirement is not about having the most money. It is about keeping the most of the money you already have. Eleanor is 61 years old, recently retired from a school district in a suburb outside of Minneapolis, and she has $412,300 in a traditional 403b, $38,500 in a Roth IRA, and $67,200 in a taxable brokerage account. Her Social Security benefit at 62 would be $1,840 per month, but she has decided to delay until 67 to get a higher amount. Her annual living expenses run about $54,200, and she has a small pension of $11,370 per year from the school district. She is healthy, her house is paid off, and she considers herself in decent shape for retirement. Eleanor does what most people in her position do. She starts withdrawing from her traditional 403b to cover the gap between her pension and her expenses, pulling roughly $42,830 per year. Combined with her pension income, her taxable income lands around $54,200, which puts her solidly in the 22% bracket for a single filer once she passes the standard deduction. Over the next 6 years before she claims Social Security, she pays about $7,400 in federal taxes annually, and she does not convert a single dollar to her Roth because she sees no reason to pay more tax than she has to right now. If your situation looks anything like Eleanor's, if you have been pulling from a traditional account to cover expenses without looking at the bracket space above you, you are likely leaving the same money on the table, and it is worth pausing to consider how much that has already cost you. Richard is also 61, retired from an engineering firm in the Research Triangle area of North Carolina, and his numbers are remarkably similar to Eleanor's. He has $408,700 in a traditional 401k, $41,200 in a Roth IRA, and $72,500 in a taxable brokerage account. His Social Security estimate at 62 is $1,910 per month. He is also delaying to 67, and his annual expenses are $53,800. He has no pension, which means his gap between income and expenses is wider, but he has been paying attention to the bracket structure. Richard takes a different approach. He starts by spending down his taxable brokerage account first, selling long-term holdings where the capital gains rate is 0% because his taxable income is low enough to qualify. That covers about $24,000 of his annual need. He then pulls $29,800 from his traditional 401k, which brings his total taxable income to just under the top of the 12% bracket for a single filer. But here is what separates him from Eleanor. He looks at the remaining space between his income and the top of the 12% bracket, and he converts an additional $35,000 from his traditional 401k into his Roth IRA, paying just 12% federal tax on that conversion. His total tax bill for the year is higher than Eleanor's in that single year, roughly $5,100. But the $35,000 he just moved into his Roth will now grow and be withdrawn completely tax-free for the rest of his life. After 6 years of doing this, Richard has shifted $210,000 from his traditional 401k into his Roth IRA, all taxed at the 12% bracket. When his RMDs begin at 73, his traditional balance is $210,000 smaller, which means his required minimum distributions are significantly lower, his Social Security taxation is reduced, and his Medicare premiums stay at the standard rate. The math on this is concrete. Richard pays approximately $25,200 in total conversion taxes over those 6 years, but he avoids an estimated $91,400 in higher taxes, IRMA surcharges, and Social Security taxation over the following 15 years. If you still have room in your current bracket this year, if your income is lower than it will be once RMDs and Social Security begin, this is your window, and it closes a little more with each year that passes. The cumulative difference between Eleanor's path and Richard's path over a 20-year retirement is approximately $66,200 in net tax savings, and that number grows if investment returns push the Roth balance higher over time. That is not the difference between a good retirement and a bad one. Both of them will be fine. But it is the difference between leaving money on the table and picking it up. Every dollar that stays in your account instead of going to the IRS is a dollar that works for you for the rest of your life. The first thing to do is pull up your most recent tax return and identify exactly which federal tax bracket you fell into last year. Look at line 15 on your Form 1040, which shows your taxable income, and compare it to the current bracket thresholds for your filing status. If you are married filing jointly and your taxable income was $89,000, you are in the 22% bracket, but you were in the 12% bracket just $5,300 below that. Knowing exactly where you sit is the starting point for every decision that follows. The second step is to map every source of income you expect this year. Social Security if you are already claiming, pension payments, required minimum distributions if applicable, rental income, dividends, interest, and any part-time work. Add them together and subtract the standard deduction for your filing status to get your projected taxable income. Then calculate the gap between that number and the top of your current bracket, because that gap is the space you have available to fill with strategic withdrawals or Roth conversions without jumping to a higher rate. If your projected taxable income is $52,000 and the top of the 12% bracket for a married couple is $94,300, you have roughly $42,300 of space that you are currently wasting if you do not use it. The third step is to fill that bracket space deliberately. Start by covering your living expenses with the most tax-efficient source. That might be your taxable brokerage account if you have long-term gains eligible for the 0% rate, or your Roth if you need income that will not affect your Social Security taxation or IRMAA calculation. Once your expenses are covered, look at the remaining bracket space and consider converting traditional IRA dollars into your Roth up to the top of the bracket. Each dollar you convert at 12% is a dollar you will never pay 22% or 24% on later, and it is a dollar that will never generate a forced RMD. The fourth step is to do this review every year before December 31st, because tax brackets, IRMAA thresholds, and your personal income picture shift annually. This is not a set it and forget it strategy. It requires an annual check-in, ideally in October or November, when you have a clear picture of the year's income. Before this year ends, you owe it to yourself to sit down with a CPA or a fee-only financial planner who understands retirement tax sequencing, because the cost of one meeting is a fraction of what the wrong withdrawal order will cost you over 20 years. Back in Columbus, the sun is starting to come through the kitchen window now, and Donald is still at the counter, but the look on his face has shifted from tension to something closer to focus. His $738,400 is not a single number anymore. It is a collection of decisions waiting to be made, some in this calendar year and some over the next decade. The spreadsheet on his screen is not the enemy. It is the instrument he will use to move dollars from one account to another at exactly the right time and in exactly the right amount. He closes the Social Security Estimator tab and opens a blank document, and at the top he types 3 words: Withdrawal Order Plan. What Donald is about to do is what separates the people who keep their money from the people who quietly, invisibly hand it back. Every retirement is a recipe, and the ingredients are the accounts you have spent decades filling. The temperature you cook at, the tax bracket you withdraw in, determines whether the dish nourishes you for 30 years or burns away a quarter of its flavor before it ever reaches the table. The seasoning is the timing, the annual adjustments, the willingness to sit down in October and look at the numbers one more time before the year closes. Your late 50s are not the most dangerous decade because the market is volatile or because your health is uncertain. They are dangerous because the tax decisions you make right now set the trajectory for every year that follows, and most of those decisions are invisible until it is too late to reverse them. If you are sitting where Donald was this morning, leave a comment and tell me the one question about your own withdrawal sequence that you have not been able to answer. That single question might be the thing someone else in this comment section needs to hear, and it might be exactly what a future video can address. If this changed how you think about the order of your withdrawals, a like helps more people find this before their own window closes.